Hello, I'm Ted Cohan, one of the Senior Portfolio Managers here at Baker Borer Bank. I'm here with John Cunnison, our Chief Investment Officer. This is going to be our 2025 Fall Economic Video Update. We just finished presenting our three live in-person ones in our three markets in Walla Walla, Tri-Cities, and Yakima. Had really good attendance, really enjoy those. If those are something you're interested in and you didn't get to go, please reach out to either John or I. We're happy to make sure you're invited to our next one. What we're going to talk about today is John's going to start out talking about the economy, a little bit about AI, and then he'll pass it back to me and I'll talk about the markets, kind of where we are, and a little bit about how AI, what he's going to talk about, affects the market. So I'll pass it over to you, John, to get started kind of talking about the economy.
Great. You know, and one of the things about the economy is I think there's a lot of fear out there. I don't know if you're hearing it from your clients.
Yep,
I think
certainly.
you are. And the fear is around, just economic health. How is the economy doing? Now, if you look at just look at the data, economic growth generally is pretty strong, surprisingly strong. I think the global growth expectation for all economies around the world at the end of last year was about 2.7%, and expectations are it'll come in at about 3.1%. So that's a significant sort of beat on what expectations were. So 0.4%, that's pretty good. That's a lot of growth that surprised markets. In the U.S., it's looking like it'll be 1.9%, but in all major economies, and the globe included, it's expecting to soften by next year. Now, there's some really good reasons, and AI is one of them, about why that growth was surprisingly strong in the U.S. as well. And we'll talk about that in just a moment. Before I do, I just want to talk about sort of two really important things as we talk about economic health. One is the labor market. And I think, as we all know, it's one of these indicators where if the economy is softening, what happens? Well, people either lay people off or don't hire as many. Well, what we're seeing in the labor market is this general decline in the number of jobs created per month. And the most recent 4 months that we have data, and of course the last month we didn't have data because of the government shutdown, but for those last 4 months, it's been very soft. So not a lot of jobs created, so some distinct weakening in the labor market. Now, if we look then at inflation, which is one of the risks that I want to highlight, or that we highlighted in the presentation, if we look at inflation, what we're seeing is that we had that big spike in inflation post-pandemic. The Federal Reserve raised interest rates, brought that down, but now we're seeing it begin to rise a bit. It's getting a bit sticky. Now, we believe that there's good reasons to think that that could persist for a little while. And basically, there's kind of two reasons. One is that the tariffs and tariff policy hasn't fully come through in consumer prices. Right. And there's a lot of reasons for that. The other is that just the fiscal situation is such that, taxes have been coming down. There's lots of depreciation benefits for businesses. All of that is stimulative, right? And probably likely to contribute to some inflationary pressure. So, and we're not predicting, another run up to 9%. It's just that it could be a little stickier than people think. And what the implication of that is for the Federal Reserve, it makes things complicated. Here they've got a softening labor market, which would, at the margins, cause them to lower rates. And they have stickier inflation, which at the margins would cause them to increase rates.
Right.
What do they do? Jerome Powell has been clear. It's a really complicated situation right now. So one of the other things that is likely to put upward pressure on inflation is basically spending that we're seeing. Now, I mentioned that part of this GDP health, the economic growth that we're seeing, part of it is coming from technology capital expenditures. And if you look at this chart, you can see that on the right-hand side, you can see that that represents about 1.9% economic growth for 2025. But we can see what makes up that 1.9%, and a growing part, right, which is kind of the yellow part you see on this chart here. A growing part is expenditures from large technology companies, primarily in the U.S., and then the rest of the economy. So if we didn't have that capital expenditure, economic growth would have been far weaker than it was. So the real question is, if this is going to continue, then that technology capital expenditure has to continue.
Right. And what is that expenditure? Is there a rough figure of what those companies are spending?
Yes, and it's extraordinarily high. The estimates are that for 2026, that expenditure will be $450 billion, coming from the top 5 firms. So that's Microsoft, Meta, Google. Which ones am I forgetting?
NVIDIA.
NVIDIA.
Yeah. And Intel. Is it Intel?
Not Intel. Anyway, but they're the main hyperscalers. Yeah. So Oracle and Amazon.
Okay.
So those are the 5. $450 billion, just to put that into context, we're talking about, if we look at the Apollo mission, so the U.S.'s effort to land a man on the moon, that in inflation-adjusted terms was $300 billion. They're talking about spending, basically Apollo mission type spending every 10 months. Wow. Is really what we're looking at as far as tech capex. What are they building? Well, they're building these enormous data centers. So here's, I think, a really interesting picture of one of those data centers. It's called Hyperion, and this is Meta's data center. It's being built in Louisiana, and this picture shows the footprint of that data center laid over Manhattan, right? And for those of you who know Manhattan, the top end of this data center is like is the north end of Central Park, and it goes all the way down to Soho, right, which is close to Wall Street. It's about 8 miles long. So this is an enormous data center. And if we think about what is a data center, that they're spending all of this money on, it's basically, you can think of it as a factory for predictions. Mm-hmm. So you've got data and cooling that's going in, and you have predictions that are coming out. Hopefully higher and higher quality predictions. For those of you who have used ChatGPT, sometimes you get wrong answers. So, they're really working on increasing the quality of the data that's coming out. But I think what's interesting about these, we hear a lot about the chips, right? And the chips are a major component to the expense, right? Probably 50 or 60% of the expense of a data center are these chips. And ongoing, they're likely to be a really big expense because these chips become obsolete very quickly. So they're going to have to replace them. But the other really big thing, of course, and we forget about this, is you've got to cool these chips. Right. So these really high-tech cooling systems, and of course there's energy.
Right. And I know that was one of the big questions at all 3 of the in-live ones, which I think was very interesting, was does the U.S. have the energy and the power to be able to keep all those going? Because they all want to be going 24/7, right? They don't ever want to be shut down.
Right. Yeah, exactly right. And you see pockets where, like in Northern Virginia, I know where a lot of these data centers are going in, you see electricity prices for consumers jumping up a lot. So these big ones, like there's one in Texas, what was it called? Stargate.
Stargate, yeah.
And then there's the one, Hyperion, that we mentioned. A lot of these data centers, they're actually building their own power sources. So right there on site. So Hyperion, Meta, they're buying these old generations, because it's all they can get, old generation natural gas turbines. Many of them are buying from Caterpillar. Because they just can't get newer technology because the demand is so high right now. And if you think about, I think next year, the U.S. is likely to use about 65, it's gigawatts. I think I'm getting that unit right. But total electricity demand, 65 gigawatts. But we need 80 to supply all these data centers. Well, where is that extra amount going to come from? So there's enormous demand for power right now. Now, one of the nice kind of externalities that you get out of all this spending and all this demand is you get innovation. So, I know nuclear power has been something we've been talking about for a long time, but there's new investments that are going into nuclear power to get more power for these data centers. So that's interesting. Now, the key question here is all this spending, is this a bubble? And Of course, in your section, you'll talk about what this is doing to markets and kind of impact it's having on the market structure. But ultimately, is it a bubble? And the way we answer that question is all of this investment going to yield profits in the future, and profits sufficient to justify the investment that we're making today? And that's a big open question that we don't have an answer to. But those profits are going to have to be really substantial. Some estimates that I've seen are, for the $2 to $3 trillion that they're putting into AI infrastructure, they're going to have to generate something like $1 trillion in revenue from that, annually at some point in the not too distant future. And as we said, those chips become obsolete very quickly, so that spending is likely to continue. The last thing I wanted to say is, whenever someone says something like a bubble, right, it's really scary. We think about the tech bubble and bust, and the market really went down quite a bit. I think it's really important, though, to realize that while as investors we need to think about that and prepare for that, and that's one of the things that we help our clients do, it is important from a societal perspective or a consumer perspective to realize that there are some benefits to bubbles. And one of those benefits is there's all this investment that creates infrastructure. We saw it during the tech bubble and bust. There was all this investment in internet infrastructure. And although at the time we saw these big losses, we were left with all these fiber optic cables that really gave rise to the next big jump up in economic growth and productivity. I think there's a lot of people who have a lot of optimism around AI as a contributor to productivity and long-term growth. So, there is a silver lining to all of this, but I think in the near to medium term, investors just need to be prepared. So the two points that I would leave, and we left our audience with at these presentations, and I leave all of you with, is one, it could be that inflation is a little higher than markets are anticipating, and we should be thinking about that. And the other is that the AI and volatility from AI, as we assess what those future cash flows are likely to be, and if they're going to be sufficient to justify current expenditures, if that doesn't, people get nervous about that, we could see some market volatility.
Right. Yeah. No, that's all good points.
So.
Yeah.
So markets, yeah.
Yeah. So I'll cover the markets a little bit as John kind of leads into that. When he talks about the AI spending, one of the things we're seeing in the market, and I think I covered this a few months ago in one of the monthly videos, is that the market's just becoming what we call top heavy. So there's a chart up now on the screen that'll show the percentage of market capitalization that the top 10 names of the S&P 500 make up of that index. So there's 500 names in the S&P 500, and on this chart, what you can see is from 1985 to 2015, that usually makes up about 15 or 20% of the overall index, those top 10 names. Now, if you look at 2025 on the far right of the chart, the top 10 names now make up 40% of the index. And what we see also is it lists the names, and I won't go through all the names, but what you'll see in 2025 is that those names are almost all exclusively tech names. The first 8 are all tech names. The first 7 are the Magnificent 7, which we've talked about before, the big tech names. And John was just talking about a lot of them, NVIDIA, Microsoft certainly being the 2 biggest right now. And then the 9th one is Berkshire Hathaway. Well, that biggest holding is Apple, so that really is a tech name. So we've just seen this incredible, again, growth of these tech names going up quite a bit. And again, we're not saying that can't necessarily continue, but what we've seen, again, because of that, if you look at the valuations, is another thing we talked about a lot at the economic updates. If you look at the S&P 500, it looks very overvalued. The PE ratio is at 22.8, which is at almost an all-time high. But then again, when you dig down deeper into it, what you see is that those top 10 names have a PE of about 30. The other 490 names in the S&P 500 have a PE of 19.5, which is much more close to the average and more reasonable.
One of the things that I think in some ways differentiates this moment from the tech bubble and bust is the strength of the balance sheets.
Right.
Of some of these.
Oh yeah, much better shape than they were balance sheets wise. And even as you talk about all the expenditures, I guess the hope for AI is that as the companies like NVIDIA and Microsoft and Apple that have all this tremendous cash flow, they can afford to make these investments. And hopefully what it does is ends up benefiting all the other companies in the S&P 500 and in the indexes. So, hopefully what happens is the big companies might spend a little more, but the AI hopefully benefits a lot of companies because another thing we've talked about a lot is not just tech names are benefiting from some of the AI.
Right.
Walmart's a one that said they're probably going to be better not having to hire as much, continue to grow with less hiring because AI is going to benefit them, but you don't think of them as a tech company.
Exactly.
Right. Yeah. So I think, again, bubble, we don't necessarily like the word bubble, but there might be a little bit of when I say correction, I'm not worried about a big sell-off, but you might see a little bit of the top-heavy names come down a little bit, that market capitalization sort of shrink a little bit with some of the smaller names coming up. So again, we're just always making sure we're well diversified in our portfolio. The other thing when we look at valuations, and we've talked about this for a fair amount over the last few years, we've increased our international exposure. International stocks have done very well over the last year. We still look at valuations of international stocks still being lower than the U.S., so we still think that's a potential for the next couple of years for them to do well. The other thing that, that kind of benefits international stocks is the dollar has been weakening over the last year. Expectations are for that to continue. When you have a weaker dollar, typically benefits international stocks. Some of the periods we've seen over time when international does really well is when we do have a weakening dollar, which again, that's economists right now, current outlook.
Yeah.
And then the last thing I just want to cover on the market is just looking at the Fed a little bit. John talked about kind of being in a sticky situation, knowing that the economy is slowing, they typically want to cut rates. If inflation stays high or gets a little bit higher, they often want to raise rates. What we saw the last meeting was a rate cut, 25 basis point rate cut. Expectations are still for a couple more this year and then a couple next year. Again, assuming that inflation doesn't start creeping up. I think as long as inflation stays somewhere where it is now, expectations are another 3 to 4 cuts into early next year. That's usually a good sign for stocks. It makes cash more readily available, more money into the economy, better for the market. It also is a good thing typically for bonds, which another important asset class that we talk about with all of our clients. As you cut rates, you get a current value of your bond. Every time rates get cut, your bonds go up in value a little bit because you get a little bit of price appreciation. Mm-hmm. You're still getting a good yield. And so one of the charts we showed at the economic update just talks about if we do get another 3 to 4 rate cuts, bonds could be in that 7-8% return over the next year. So they still play an important part. So I think in summary on the market side, and let me know if I missed anything here, is just that really we're still always going to look at being very well diversified, making sure, again, we have exposure to those top heavy names. We want to have exposure to AI names, and we do. We just also want to make sure we have exposure to the value side, to mid-cap, small-cap stocks, and then also very important to have that international and bond exposure.
Kind of a wide range of potential outcomes here.
Right.
And we want to be well-positioned for whatever transpires in markets.
Exactly. So you benefit from the growth, but also hopefully trying to limit that downside risk a little bit. So take good risk, and there's always risk in the market, but making sure you take, good consolidated risk.
Right, and thinking about inflation, we've got all sorts of tools in our toolbox to deal with inflation. On the bond side, it's inflation swaps are a potential solution for a bond-heavy portfolio for those clients that have a lot of bonds. And then when we think about a portfolio that has more stock exposure, real assets are an interesting place to allocate to. So a lot of solutions. Yeah. So
exactly. And real assets, for everybody that doesn't know, really, we're talking about like real estate, infrastructure, some precious metals, basic materials. Yeah. Which I think is an important part.
Yeah. Well, thanks for joining us today. We truly appreciate it. If you have any questions about anything we've said here today or anything else, please reach out to us. And again, if this is of interest to you and you want to join us the next time we have an economic update, please reach out to either Ted or myself, and we'll be happy to make sure you get an invite. Again, thanks for joining us, and stay well.